This video is on the cost of cash. In the previous video, we talked about WACC, your weighted average cost of capital. And so now I want to talk about the cost of cash. And this is a specific application of WACC because cash is just another form of capital. Now, most people think of cash as free. People will look at $1 of cash and say, this dollar is worth $1. But on a theoretical level, for a business, that's not necessarily the case. Because that cash came from somewhere. It came from some capital raising activity, and so there's a cost associated with that. Let's say you issued stock. Let's say your company issued stock, or it issued bonds, or you had an investor come and invest money in your business. There's costs associated with each of those activities to bring cash into your business. And so there's a cost associated with cash. So what is that cost? Well, the cost of cash is going to be your WACC. Because if you remember, your weighted average cost of capital looks at all of the sources of capital, all the ways you brought money into your company, and comes up with what was the overall cost for that. So no matter what you use your money for, you could have used your capital to build a building, you could have manufactured products, or you could have simply hoarded all that cash. If you just hold onto that cash, there's still a cost associated with bringing that capital into your company. We can use an even simpler example. Let's say all you did for your company was you issued a bank loan, or you received a bank loan. So the bank would have given you a large sum of money, and you would have agreed to pay a set interest payment each period. Well, the interest payment that you're paying, that's the cost that you paid to bring this cash into your company. So that's the cost of your cash. And this is important to realize because that cost was calculated based on the riskiness of your business. So the cost of cash is based on your cost of capital, and your cost of capital is based on your risk. Now, I don't want to just keep talking about this on a theoretical level because I think there's very practical applications for this in the day-to-day operations of your business and the strategic decisions that you're making. Because something happens every year. Every year you give a budget to your managers. And in that budget, each manager has a certain amount of cash to spend. And most managers look at this cash and they think of it as free money. They think, that's the cash that's there, this is what I have, and I have this money to help achieve my goals throughout the year. But that's not necessarily the case because there's a cost associated with that cash. So, hopefully your managers are engaged in these activities that will eventually generate profit for the company. And, it doesn't have to be short-term profit. It could be a longer-term profit. These could be multi-year projects they're working on. But at some point, value should be created, and it should be created enough to give you a return on investment, not only to replace the cash, but to replace the cost of acquiring that cash. So your activities need to go above that hurdle rate that is set based on your WACC and based on the riskiness of your company. So I'm going to take this even a step further. And let's look at the hypothetical example that someone just gives your business money. Now let me preface this by saying this is never going to happen. No one is ever going to just come along and give you money, no strings attached. But hypothetically, let's just consider this example. Someone comes along and gives your business a boatload of money. Now you might ask me then, well, is this cash really free? And the answer is no, it's still not free money. It's capital and there's always a cost associated with it. At the bare minimum, there's an opportunity cost to that because that investor that gave you all this free money, they could have taken that money and invested it in a business that's similar to yours with a similar level of risk and achieved some level of return for that money. So in giving it to you, if you don't generate that same level of return, you're really destroying value in the underlying capital of your company. Because you could just go along and take that money and invest it in a similar business and get some level of return. So that is what we're talking about here. I think this really gets to the heart of this concept. And that is that the profits your company generates are related to the underlying risk of your business. And you need to get above that hurdle rate of the cost of your capital. So I'd like to end with this concept again, that your business is a machine. And capital flows in one side of the machine and profits flow out the other side. And all the capital that comes in, no matter what form it takes, whether it's cash, whether it's bank loans, whether it's stock, that capital has a cost associated with it that's based on the riskiness of your business. And all capital has a cost.